If you're my client now, I'd call you up 6 months before your fixed rate expires and say, right, what are your plans? What do you want to do? What are your incomes? Right, we can facilitate what you want to do, either remove or remortgage, stay where you are, all these things. But with interest rates starting to incrementally go down, I'm not going to pull the trigger on an application immediately, because of the fact that if we wait until we're closer to the point, we might be able to get you a better deal. There is some merit in sort of saying, secure something now, because you don't know what's going to change in the very near future. And like it's talking about geopolitical issues and what have you. If war kicks off in various parts of the world, it might have a knock-on effect to the way the finances are affected and things like that. So maybe having something locked in where you go, right, that's worst case scenario, and then talk to your broker over the course of the next 6 months to see whether or not things get better. And if things keep drifting downwards, we only need around about 6 weeks before your expiry date to switch you to a new lender. If you want to stay with your current lender, we can do it all the way up to the 20th or so of the month before your rate expires. And that's only because the bank needs to have time to set up your direct debit for the new rate when your next payment comes out.
Is it ever beneficial to come off the fixed rate onto the...
So I've got actually one of your listeners has got in touch with me, and we've run a whole scenario. They remortgaged at a point where, the Liz Trust budget and rates went up, their fixed rate expired. It's a timing thing. They had to remortgage. They had to take the product that was available. They took a 5-year fixed rate for some reason, maybe thinking things were going to get worse. But we've done a sort of cost analysis of all of that versus what we're on now, and we can get them a cheaper mortgage product that would make it worthwhile them paying the exit penalty and still save them money on what they're on at the moment. The rates are still continuing to drop, so they are just holding until we, hopefully get to a point where they go, right, it's enough money.
It's going to be a better and better deal for them then as well. So that if it makes sense now, if rates do drop like we anticipate, correct, it will get better.
And that's the problem with that, is that, we've done all the analysis, we've worked out it's worth doing, but the right advice is actually, I don't want you to pull the trigger just yet because it's likely to get better. But if you're buying a house, you have to pull the trigger. But then if you've got 3 to 4 months between your offer being accepted and your mortgage going live or you drawing down on it, we have got the time to review those rates, and I might even change lender entirely. I've had cases where I've applied to NatWest for, the start of the mortgage. Halfway through, Barclays has come out with this amazing rate, and we've gone to Barclays and we've got another mortgage offer. A lot of mortgage brokers don't like doing that, but the right advice is to do it and get that in play. Keep the NatWest one live, keep the Barclays one live, and then run them both concurrently. And hopefully, if either one of those rates improve again, because when you're dealing with a top 6 lender, they're super competitive. They have to get a certain amount of money in through the door in order to keep their doors open. So they are always looking at where do I need, and they control their volume of money coming in by the rates and the position on the table that they take. So if you find that NatWest had a bit of a quiet August, you might find that in September they go, we need to do something on this because we need to get more market share, otherwise we'll be losing overall.
This was from our full-length conversation with mortgage broker Anthony Emerson, where we focused on everything you need to know about mortgages. You can watch the full episode right here.